traders, this is Blake Morrow. You are listening to the Morning Edge webinar. We're going to bring Ed Matz on in just a second. I just want to make sure that we get the data in real quick. Let me grab the Japanese yen. I'm gonna unmic Ed in just a second. I gotta find him. Okay, remember we have CPI data coming out. We also have Empire State Manufacturing. Okay, let me find Ed. There he is. I'm going to unmute him really quick. Hey, good morning, Ed. Can you hear me?
Blake, loud and clear.
Hey, how's it going? Yeah, I can hear you
Very
great.
good.
Hey, real quick, let me just say that the CPI data came out or is coming out right now, and same with Empire State Manufacturing. Looks like the data is pretty much in line. It is actually in line with expectations. Empire State Manufacturing must have came in a little bit better. We're getting the dollar's firming up just a hair against everything. And you know what, Ed? I meant to spring it on you just a little bit ago, and then I let it out. I had to bring Chris Bear in with us. You know, I had to.
No, I've never heard of him.
Chris, are you there?
Good morning, Blake. Good morning, Ed. How are you?
Chris, I'm very good, very good. Glad to well, I can't see you, but glad to hear you.
Yeah, it's been a while. It's really nice to hear your voice, and I'm really interested in what you're going to present today. It's really
burgers, mate. It's all about the burgers, yeah.
Yeah, it's all about
That's
beef.
such a good song. All about the beef. You know where that comes? I didn't tell you. It's pre-election year. Yeah, we've got elections coming in. It's the 1985. Obviously, it's a Wendy's. Where's the beef? Is Wendy's burger ad, but it's also famously. I was going to say you guys are probably too. Blake certainly is too young to remember that, but I think I'm too young to remember. It's the Water Mondale 1985 election. Where's the beef?
Yes, of course. Oh, and Chris is definitely old enough. Just kidding. I'm harassing you, Chris. Ooh,
I'm old enough, but for the first 20 years of my life, I didn't care.
Yeah, right.
Do they like their burgers in Brazil?
Oh yeah. Listen, I throw parties here, and it's amazing. Everybody, please do your burgers again. Do your burgers again. They're crazy for them. But I mean, I also do them very well, though, so they're great.
Oh man, I can only imagine, and you know, in Brazil it's hard to beat because Brazilian barbecue is, you know what I found out from all my Brazilian friends is all it is salt. It's just salt.
Yeah, well,
That's a bit harsh because I actually you and I have talked about this, Blake, and I got talking to Chris about it because we have a tradition in our family. We're big Formula One fans, or my wife is, or her family is, and so every time there's a Grand Prix, we throw a party, have a party themed around that country. So it was the Brazilian Grand Prix, and so what the heck do they eat in Brazil? And so I was speaking to you at the time, and you said it's just barbecue.
Oh, I lost you for a second, Ed. Are you there?
Yeah, hang on, let me try something. Can you hear me?
Yeah, you went to like a different mic, like more of a speaker.
Okay. Is that better?
No, you're still. It sounds like you're in a room. So it sounds like your computer speaker. So I think your microphone, whatever microphone you were using, is not picking up. Chris, are you still there?
yes, I'm here.
Okay, I can hear you just fine.
Do you want me to tell you what Ed was going to say?
Yeah, tell me.
Yeah, actually, Chris, could
there you go. That's better. That's better. Okay, so your mic is back.
Yeah, that's because when I get too carried away, I start moving, and
and you yank the cord out of the computer. I got it. I got it. Hey, so you know, we don't have a whole lot of time, and I actually do want to hear what happened during your Formula One story. But I know everybody's here wanting to know your technical viewpoints on, you know, we obviously tomorrow's telegraphed probably one of the biggest days of the market in years. So is it going to be one of the biggest days in the market in years because it's so well known? I think it's so well known what's going to happen, what the actions are going to be taken. So how's the market going to react to all that, Ed?
Juno, can you share your screen? Can I? Can you speak?
Yep, I can. I will. I'll do it right now. I'm going to make you a presenter. So just give me 1 second, please.
Do I have to do anything?
No, you don't have to do anything, but I have to find you really quick. So just give me a second to do so. And
I'm looking at this chart you have up, and I'm like, wow, what the hell is this thing? It's moving so much. Then I realized it's a 1 minute chart, huh?
It was a 1 minute chart of the dollar yen. Sorry, I was following the CPI data. I don't only do that after a news event. Now, that's enough to give you a headache, huh? All right, so Ed, you should have, yes, there's the burger. I see the Wendy's burger. Man, you must be really into the Wendy's burger right now. Yeah. I like it.
My burgers look nothing like that. Let me just tell you.
Yes, I agree.
Better.
It makes you hungry, though.
It is square.
All right, that is kind of like where's the beef? Because I have a bit of a beef, but also it's about evidence. We're inundated, have been for months, it seems, about what's going to happen tomorrow. Are they going to raise rates? Is it the biggest day since Christendom, or is it going to be a non-event? Lots of people arguing deductively about what's going to happen, and therefore saying, well, in fact, very little or not as much has actually been talked about the impact and what you would expect to see happen. A lot of it is, are they going to raise rates or not? And it begs lots of questions as to is this going to be the first step in a tightening cycle since 2004? And the answer is, well, hang on. Wasn't quantitative easing, wasn't taper? Wasn't that the first step in the tightening cycle? And wasn't October the 29th, 2014, when quantitative easing ended, wasn't that the first step? And therefore, are we kind of is this such a big event as people think? Is historically raising rates, historically may have been a big event, but we're in a new uncharted territory because of quantitative easing. And these are questions that aren't really, they are put out there, they are discussed, but they're not linked with evidence. What has happened previously when the Fed has raised interest rates, if they're going to raise interest rates? And that's really where I wanted to come from. That was my beef, is evidence-based analysis and therefore evidence-based trading. You think that, then therefore where's your evidence for believing that? You want to put money on that, well surely you've evidenced it, you've researched it. And I can go off on one here about all sorts of things like head and shoulders on the DAX. People put money on it, but 75% of them don't work, whereas head and shoulders on the S&P, 75% of them do. Correlations, the yen historically is a risk asset or inverse to a risk asset, and yet at the moment that's completely out the window. There are times in history when that's been the case. Trend lines, they tested 3 times and they break. We all work on these things we believe to be true, but to what extent do we research them? To what extent do we evidence them? To what extent is it obvious that if the Fed raises rates, the dollar goes up and stock markets go down and interest rate related markets like notes, 10-year yields, they go up? To what extent does it really happen? Have we looked at the chart? Have we looked at history to find the answer? Because too often we're right in the wrong market, and believe it or not, actually what we want to be is be right better to be right in the wrong market than be wrong in the right market. It's about making money, about trading, and that's, you can understand, I really am going off on one here, you can understand why we don't, because all the information, a lot of the information we get, quite shallow, some of it, is aimed at the general populace and not specifically at the trader. In other words, to the populace, to people in the economy running businesses, it is important if interest rates go up. But it's not important to them necessarily if the dollar goes bid on that or the stock market goes down, unless they're holding. If they're going to buy a few yards of dollars, or they're going to buy a shedload of S&Ps on the back of it as a trader, then that's important. And that's where there is a bit of disconnect between the information flows we get. We don't get the evidence, and that's having gone off on one. That's really what I wanted to briefly mention, is talk about some of the history. And the obvious one is, and no disrespect to anyone, is the obvious one is they raise rates, and so the dollar goes bid. Is that historically what's happened? Do we know?
No, it's actually, it isn't.
Correct. Okay, can you see the chart in front of me?
Yes.
Okay, basically what happened to the dollar index. You'd think the dollar index would be the best way of stripping out the euro, etc. It is the best representation of the US dollar. Well, clearly the dollar index is too heavily weighted in favor of the euro, and therefore is too much of an anti-euro index rather than a dollar index. But it does raise an important point, because what we're trying to do is strip out the other currencies, because it's the two sides of the argument. Yeah, I mean, dollar rates can go up, and therefore the dollar should ordinarily, you would think, textbook says it goes up. But what if rates in Britain go up a week later, then maybe even faster? Then that's going to nullify all the opposite for the pound dollar rate, and that's not necessarily the case. So we try to strip out as much as we can through the dollar index necessary to get what get a better idea historically what has happened when they've tightened. If you look in the bottom left-hand chart, you can see quantitative easing. Let's argue that tightening started when quantitative easing actually finished October 29th of 24 last year. And well, in fact, the dollar went bid to kingdom come. It went very, very strong. So you could argue that it's actually all this tightening has already been factored into the dollar rate, and all we're talking about is a continuation. The closest chart we've got probably to that, in fact, is the euro dollar and the Canadian dollar. That a lot of the last year could be argued to be just a firming up of dollar rates, or an end of relatively easy monetary policy. In other words, a tightening. So maybe tomorrow is no big deal. However, if you look at some of the charts we're about to look at, you can see that actually it is slightly different. And certainly from a fractal point of view, just as an aside, all a fractal is a piece of price action that can be repeated, copied, or matched, or compared. So it covers everything, really. Fundamentals, head and shoulders, whatever formation, correlations, whatever. All it is talking about is comparison. Whether there's a reason for the comparison or it was just price, it's still a comparison. But a lot of what I can see from this chart alone is quite clear. This is the point you've made, Blake, is that the dollar weakens. So you would think, well, hang on, then maybe this is by the rumor sell the fact that we've expected a rate hike. 80% of the 75-80% of the market believes they will raise rates tomorrow, apparently. I don't know, that's not what I'm getting. I'm getting a lower figure, really, amongst people I talk to. There's a few dissenters, if you like. And in fact, 80% of the rate hike is 25 basis points is already priced in. So only about 4 basis points is not priced in. So it's not a huge move should they raise rates. But if they didn't raise rates, that's 20 basis points. That is has to be reflected if people assume they're not going to raise rates for a while, but that's probably not the case either. So if you look at history, that's where I'm coming from, what has happened? Well, we see quite clearly from every instance. In fact, in 1994, the dollar went bid initially, but then fell for the next 6 months before stabilizing. The same in one that people aren't talking about, and they should be, for stock market related reasons, is the 86-87 tightening. People tend to talk about the last three, but this is the previous fourth one. Same thing. You could argue that, in fact, the dollar was going down already, and it was, and that's why you have to exclude 1986-87 from a Forex point of view. It's because of G5 Plaza. It was a monetary policy to devalue the dollar already in place. So that's not interesting at all to any real extent. More interesting, however, though, is 1999 and 2004. 2004 because that was a tightening in a relatively low inflationary period. Similar events elsewhere in the world, you could argue, and therefore is probably the most real comparison. And again, what do we see there? Well, we see, in fact, the first move is for the dollar to stabilize, and then later it weakens before it rallies later, about 6 months later. And more interestingly, from a fractal point of view, from a price action point of view alone, is 1999, and those people are my customers. MarketVisionTV.com, ding ding, end of commercial. Anyone who follows me will know that there's a lot of markets that have a great affinity to 1998, 1999 price action. You don't need to argue the case fundamentally, although what is really interesting is that the euro was born in 1999. And so does that affect things from a comparative point of view? Certainly the price action is very similar. What we have here is the price action. You can see what happened after the raised rates in 1999. Dollar went bid and then retraced quite heavily. You're talking about 700 or 800 points on the DAX, 7-8% for the 3 to 4 months before it carried on its already existing uptrend. I think from a dollar index point of view, well, I know the three of us were monster bullish on dollar index like 30% ago. Years ago. It's been a massive uptrend, and I still think it's a massive uptrend, but there's clearly scope. And what it's saying is that this is providing an opportunity in the next, whether it happens tomorrow or happens in January. It's saying that the dollar should go bid initially on the impact, but that if it does, we need to stop thinking about a long dollar scenario for a while. And that the dollar will. Yeah, please interrupt any time.
Do you mind if I stop you for a second? So you're highlighting the price action of 1999, which you would think based on fractals and based on, you know, because the euro, it was in the inception of the euro that year, that we could very easily follow the 1999 analogy where we go bid and like you're pointing out there, and I the thing is, Ed, is I completely agree with this analogy, is that we could rally following the Fed meeting tomorrow if the Fed raises rates, right? And let's say we go bid throughout the end of the year into January, and then January, maybe sometime January, mid-January, usually when the markets tend to shift anyway. It's usually the second week in January, right? And then maybe the dollar sells off quite dramatically following, you know, after you get the end of the year flows that come through, and then we sell off going in the beginning of you know, 2016. If I'm following you correctly, that's what you're trying to point out here. Is that correct?
Essentially, yeah. What I'm trying to do is try and find the best match, and the bottom line that I'll come to now is very slightly from the currency you're looking at, but they're all saying a very similar story. They're all saying that's the opportunity if they raise rates and the dollar goes bid, whether it's for a day or a week or a couple or a month or so. Then it's an opportunity. You should seriously be thinking of getting out of a long dollar position, long dollar stance, however you want, you know, your strategy, because the dollar is likely to retrace. And you can see it better here in the what I've got on the euro.
Great.
Similar charts, obviously, and they're going to be slightly different, but not a lot of different. But you can see. Again, it's the 1991, the 1999 period that is the key. Could be a little bit careful because that was the birth of the euro, and so 6 months after the euro was born, the Fed enters a tightening cycle. The euro's not had a great start, so it's going to alter things slightly, but the general impression is quite clear. In these small blue boxes is their daily bar, so this is the immediate reaction of the Fed raising rates. And you can see 1986-87, there's no impact whatsoever for about 2 or 3 days. And then the euro goes bid, the dollar weakens. No impact at all, which is quite surprising. Anyone around 86-87, that's a fascinating period in history there. Go to the one we were talking about, 1999, and you can see this very analogous. This basically, I put in a projection here based on all of these euro-dollar fractals coming together, and you know, weighting it, if you like, to what I think there's a better match, not just price action, but also fundamentally and also politically as well. Yeah, we're talking about an election coming up next year, and we're talking about raising rates into the election. But this is, you can see in 1999 what happened. The euro actually went bid on the day and then drifted off, which is your scenario, actually. That's if they raise rates. In fact, this is almost more. This is the 1999 fractal, if you like, is almost akin to them not raising rates. In other words, they go, oh wow, they haven't raised rates, and and then you see the market just go head to tail and does acts in the contrary way. But basically, it's saying 1999 is the period of consolidation, and any opportunity into year end, your point, is an opportunity to get out of a long dollar, because that's what. And again, look at 93, 94. Look at February the 4th, 1994. The immediate reaction to them raising rates was the dollar. The euro dollar dumped, the dollar went bid, and again that was the low tick. That day into the 2 days after was the low tick. So you could, and the same here. Look, Blake, from this price action, what it's saying is if they raise rates, there should be an initial dollar rally, and then it's a momentum loss. Watch out for the momentum loss, because it's the momentum loss that will be the key to getting out. Getting out of on long dollars, short euros. And starting to sweat a bit, but that'll be the opportunity to get out and start, going the other way. And maybe, depending on how you trade, you may want to start positioning to be long euros or short dollars, whatever. And again, in the last one, in the low inflation period, which is obviously economically is probably a better match, 2004, June the 30th. The initial reaction was for the euro to go bid. Immediately went bid as they raised rates. Again, priced in. You would imagine that's
right. Okay, so I'm going to ask you a question. This comes from Wit, but I have it's basically the same question. And Chris, I'm assuming you're still here as well. But you got the ECB, which is doing quantitative easing. Obviously, we're in a different. You can go back in history and look at these different time frames, but in no time in history have we had one central bank loosening the way that the ECB is doing and adding liquidity to the market versus the Fed extracting. And yes, the Fed has been.
Things are different because obviously there are other central banks doing their own thing. I'm jumping to dollar yen,
okay.
And the point here is. See the bottom left-hand side where my
yeah.
It went ballistic,
Right.
A lot of that ballistic move was Kuruda, was the Bank of Japan quantitative easing. So not only did you have arguably a tightening already at the end of quantitative easing, but in fact you had a significant easing in the from the Bank of Japan. So the point's valid. It's not, you can't argue entirely, obviously, and the point of using the dollar index was to strip out, to average out some of the more localized effects elsewhere. Yeah, if the Fed does something that's relatively muted or expected, and the ECB does something that's dramatic, it's going to have a big impact. Which, let me just show you why. So I'm just going to flip around here. The Aussie. Okay. Because I actually think the Aussie tells a story, and a reason I bring this in, because I think it's the point. The question is a very important question, because look, they haven't extended quantitative easing in the ECB as people were expecting. So it's rolled over into January. So as, let's say, they raise rates immediately, or they don't raise rates immediately, the impact, people are going to say, well, hang on, what's the ECB going to do in January? I'm trading the euro dollar. The euro is just as important as the US dollar. Therefore, what are they going to do? And if you look at the Aussie, it actually tells a really important story, because actually what's happened, it's consolidated. It consolidates. And I think, personally, what it's saying is because of the ECB in January and further possible quantitative easing, is that you're going to see the market consolidate more. It's not going to burst into a new trend. So again, the same point happens, is the dollar, if it goes bid in the next day or so after the raising rates, it's an opportunity to get out. But we're getting out for what will probably be a consolidation range before. I think there's the potential for dollar weakness later, but basically before it determines its next trend. In other words, the market will take the same view. The market will be of, well, hang on, that's the US sorted. What about the ECB? And I think that's why the Aussie actually incidentally is saying the same story, is that it's actually likely to go sideways, but before dollar weakness. It's already well bid anyway. Maybe it's telling us something. Yeah, I've got a couple other things on cable that tells us similar story.
I was going to say
too much information.
Yeah, no, it's great. I was going to say, do you factor in with the cable? Do you factor anything about possible Brexit vote coming into this next year? Does that factor into your analysis at all?
Well, it depends on the type of analysis. Clearly, I factor it I am essentially, although I might be known for fractals, might be known for Elliott wave, people might know and realize I am a bit of an economist on the side, having been pretty well educated in economics. I'm a macro trader. So yes, I actually think it's one of the biggest numbers, biggest non-debates out there is Brexit. It ain't going to happen. You're talking to someone who probably would vote for it as well. So it's a bit like the Scottish referendum. It's going to have an effect. The effect is going to put it sideways. In fact, a lot of these charts on cable is sideways. And cable will weaken as people, you start putting uncertainty that maybe the UK is going to leave. It's an unknown. Markets hate uncertainty. If you create a referendum about leaving the European Union, that is an uncertainty in itself. Leaving the European Union is a massive uncertainty. And it is the biggest argument, quite frankly, in favour of staying in, is because we don't know what would lie at and that's why any vote will actually, I think, quite heavily side, if it's the argument's properly put, side with staying in, because we just don't know. It's too big a risk to take. But that will have a twofold effect. The market will go sideways, but it also will go depressed sideways because we don't like uncertainty. And that's essentially what these charts are saying. It's a good point, because evidence-based analysis means not only use the evidence for the factor you're looking at to determine and then see how price action tallies, but use the evidence to determine what the key drivers are. It's all very well talking about US interest rates. When you're looking at cable, if Brexit is the issue, then what has been history saying about similar events, maybe other countries, pulling out of unions, or similar events in UK history, maybe Black Wednesday, wow, going back to 1992, there's some comparisons there on something like Euro Sterling. Maybe that's part of the story. You look at that price action as well. Go with whatever's driving, this is point about evidence, whatever's driving the market, then research it and look and try and tie in the price action, see the consistencies and see if that continues to drive it. And if that factor no longer drives the market, then look at something else. And it's all about bringing the evidence together. And once you've got the evidence that shows what you're analyzing, your analysis is more accurate, then you can start building trading strategies around that analysis. And the problem is, otherwise, you can have the best system trade that's ever created. And you can make a fortune for the next 3 months on the back of that system. But the market changes, and your system suddenly is out of kilter, because your system was geared on based or happened to not fluke it, but coincide with a series of other factors. But those factors have changed. So people ask, a number of people have asked me over time, this is their trading record and they've done really well in the last year. You need to trade over a full trading cycle, 4 or 5 years, to be able to tell whether you can really cut it professionally as a long-term career, because things change. Your system, your approach needs to be tested over time because factors and markets change. But anyway, Brexit, yeah, a non-event, but it's going to have an effect, the whole uncertainty issue.
Sure.
About,
well, Ed, we're running short on time. I wanted to ask Chris, did you have anything that you wanted to discuss with Ed other than burgers? Because I'm hungry now. Thank you very much. Chris, are you there? Chris?
Yeah, Blake?
Oh, there he is. Yeah, okay.
Yeah, okay, sorry. Yeah, I just wanted to get his viewpoint on CAD and the weekly, and maybe some kind of cycle work. What do you think's going on with the
I just don't. I'm always guilty. I'm always worried about presenting too much. You need to filter out information, and I have too much information here to impart. But it is the Canadian dollar, which is fascinating. I made a point earlier about the CAD. Canadian dollar is probably one of the better reflections of the end of quantitative easing as representing tightening, pre-existing tightening, and therefore they raise rates tomorrow in a month's time.
The CAD is retracing.
Yeah, dollar CADs. If any market out there has buy the rumor, sell the fact in it, it's dollar Canada.
Ed, I just want to confirm with you that I'm thinking correctly. Isn't it because markets are ahead of what's happening?
You mean the old adage about fundamentals, technicals lead fundamentals? The price is in to the extent before. Well, there's a lot. Yeah, yes is the answer. I definitely believe that markets will anticipate reversals, and therefore, you could argue that dollar Canada is not pricing and is not ahead of the game because it's the other way. And in fact, the dollar Canada, I think, in this instance, is a bad example because quite clearly what's happening with the Canadian dollar is oil, and it's too big. Is too big a factor on. Are we going?
Yeah, I had to take back the screen because Kip Cohen is going to be taking over here just in a moment. But continue on. He's here. He's listening in.
Yeah, I'm here.
But I just want to figure out your last thoughts here.
Yeah, Chris, interesting. Put an analogy up, a fractal. It's nice to see him using that approach. Some of the history that he remembers from previous, and he's absolutely right. That what we're in a tail end market in the Canadian dollar, analogous to some markets like sterling yen, which is what that analogy has worked very well in recent times until very recently, and the oil has taken over. And it's in the tail end of the market. The question is the volatility. I mean, it's again being right in the wrong market. You could be right that dollar Canada is in the tail end and that it will reverse. It could be tomorrow, could be the trigger. You're talking about dollar weakness, could be the trigger. Dollar Canada could be the biggest buy the rumor, sell the fact out there. But the oil price is driving the market too much. You need to correlate Canada to oil and then look at what oil is doing. And dollar Canada ain't going to reverse until oil does to any real extent, because any move on the back of US interest rates in dollar Canada won't be sustained unless the oil market does something as well.
And that's a great comment, and probably a comment we have to end on, but I agree with that wholeheartedly, Ed.
Can I just add one quick thing?
Yeah, sure thing.
My opinion is that oil will spend the better part of 2016 above 50.
Well, then that would if that is the case, then and Ed is correct, then the dollar Canadian will probably be, the exchange will probably be close to 132, if not even lower. So I would have to agree with that.
Yeah, if you've got dollar weakness for 3 months and you've got oil above 50, then yours at 132. Yeah,
easily.
That's 120s, I think.
Maybe.
It depends on it. It's always a lot of these markets.
I get fair value about 125, 126 for CAD on a monthly.
And there we go, folks. And Ed, I apologize that we should have planned this out better. I know it was more of a last minute thing. And because you, Chris, and I could talk for like a good hour easily. So, but I want to thank you for your time. I want to thank you for being here with us today, and really your outlook on the dollar ahead of the FOMC. And Chris, I want to thank you for being here to harass Ed with me. It's always a great time to have you here.
It was my pleasure. Great to hear your voice, Ed, and Blake. Thanks, and thanks for everybody for listening. And I'll catch you guys later.
All right, thanks, Chris, and thank you, Ed, for being so gracious with your time.
That's great. I enjoyed it, and Chris, line up the burgers, yeah.
Very good.
And by the way, don't forget to catch Ed on Market Vision TV and follow him at EdMats on Twitter. So, thank you, Ed. We will catch you in Twitter sphere, and you too, Chris.
Okay, guys.
Bye-bye. Thanks, guys. And all the best for tomorrow, yeah.
All right. Yeah. Same to you. Bye-bye. And Kip. Good morning. Good morning. Sorry about that. We ran over a little bit there, but Ed's always an interesting person to have on. His point of view and fractals and how he goes about the market. Some people refer to him a bit of a wizard. He is he definitely is really good at what he does. So
you'll need to bring him back again soon for maybe a longer period of time.
Yeah, we usually spend about an hour, but it was going in at FOMC. It was a last minute thing, and but it was nice to have them on anyway. So I appreciate your patience. I appreciate everybody else's patience. I will see you guys in three hours on the Lunch Money webinar.
Thanks, Blaker. Have a good morning.
Thanks, Kip. You too. Bye-bye.